returns until the reserves were depleted. For expenses, I assumed a weighted average of $8.40 per barrel of oil equivalent, and then decreased it 40 cents year over year, assuming the same law of diminishing returns and operational efficiencies. Once I got the present debt value of my profit, I took out their debt as of 2018 and divided by my shares outstanding. Lastly, to touch on management, their CEO, chairman, and president, Mark Papa, has years of experience in this industry as he took EOG Resources to the second largest independent oil producer by market value. With that, I'd like to open the floor to questions.
All right, thank you, Ben. Let's start with Eric. Eric? So my question is in regard to your second driver. You mentioned a report that's published, and then how as a result of this report, the company's going to be able to strategically place its wells in order to increase production. Can you kind of comment on if management is aware of this report, because it only stands out if they know these facts?
So the question was regarding my second driver, which is parent well versus child wells. Mark Papa, the CEO, has gone on record multiple times to discuss this matter. That's where I first found out about it, that a lot of these other companies, if you look under the hood, they're actually just completing more child wells compared to parent wells. And since he knows about that and is willing to be open about it, I think going forward, he's going to strategically place them.
Just talking like factor analysis and like the portfolio in general, when we looked at it in class, like we were heavy with momentum. Where do you see like the stock fitting into the portfolio, like value, growth, momentum?
So the question was whether this company is going to be a value or growth company. I think it has a lot of value in there. We're buying it at a steep discount, dropped nearly 60%. And with a lot of our portfolio still in momentum, I think this will sort of balance this out. It won't obviously be enough to do so, but I think it gives us a start to be able to kind of balance our weights and with value with value versus growth.
And your first risk is basically about the rising oil prices, or like what will happen with commodity prices. Did you first off model any change in oil price in, or did you do analysis?
So the question, that's a good question. So the question was about oil prices and the fluctuations in my DCF model. I did model that in, but I have production growing for crude oil year over year larger than natural gas and natural gas liquids. So I just assumed a price increase and decrease of 10% year over year for every single sector. So oil, I started with $58 and increased 10% year over year. Natural gas 2.75 and natural gas liquids at 27. So a 10% increase got me around $23.69, and then 10% decrease is like $1.22.
Yeah. So when did they alter their guidance to the 12% year-over-year growth? What was it before that?
They were looking to do 65,000 barrels of oil a day. That's what like their goal was in 2017, looking out into 2019. They ultimately hit that at Q4 of 2018, but then in like Q2, Q3 area, they were going to scale back doing like maybe 55 to 60,000 barrels of oil a day. If oil prices are to stabilize, hopefully with OPEC in June, July, then they're going to look to expand even more.
So just looking at your third risk, you're saying this is about competition or competition. Do you know exactly what their structured contracts are? So that's 50% revenue that are derived.
So the three largest customers right there are Royal Dutch Shell, BP, and Eagle Claw. Eagle Claw takes care of the residue gas. Royal Dutch Shell and then BP buy the oil directly from them. I think they'll be. What was the question? Sorry. Oh, the structure of the contract is they just have to produce like up to like 20,000 barrels a day, but if they don't, then they curtail it back and like they reduce the amount. They also have to pay a fee if they don't hit that mark.
Well, so maybe this is overkill, but just to dig back into Andy's question, it sounds like you sensitize the commodity price as well. Did you do any sort of regression to kind of see how stock price is tied to the commodity price?
I did do a correlation to oil. It was about 0.55.
Okay, cool.
Okay, using net asset value approach to valuation, use multiple valuations. NAV was one of them. Walk me through that.
As I briefly touched on before, so I took my production rates for the first 5 years across all three segments, and then I assumed the long-term production decline because they're not like the law of diminishing returns, operational efficiencies. You're not gonna be able to produce as much, and then at present valued all those cash flows, assuming a price of 64, 2.75, and like $27 from 2023 to like 2029 when they're all about depleted. Present value though took out expenses 8.4, started in 2819, decreased those 40 cents because of operational efficiencies. took that net, got my present value of my profit, and then took out debt, and then divided my shares outstanding.
All right, so touching on your second driver, we've already got pretty nice margins. And your second driver, I think, sort of alludes to further margin expansion. Did you model that in already, or is there going to possibly be even more margin expansion on top of like that 30?
So the question was regarding margin expansion, my second driver, and if I modeled it in. I did model it in. I started reducing a lot of my barrel costs, so like lease operating expenses, and then my taxes that went along with producing oil. I started decreasing those in about 2021, 2022, and I think the growth phase will finally be fully implemented when those efficiencies will take place.
Besides the price of oil, what is the most important thing to watch over the next 6 to 12 months to determine if this stock is on track?
So I think the question was, what's the most important thing besides commodity prices track? I think it's going to be their balance sheet. Are they going to be able to have liquidity in the next 2 years to withhold this production cut? I think they're going to try to extend the runway as long as they can until the prices rise, but there's only a certain length of the runway. I'm thinking it's about 2.5 years that they can really hold themselves off. But if not, then I think we'd have to sell it at that time.
Okay. Thank you, Ben. Next up, James Oddo.
Good morning, everybody. I'd like to thank you all for being here, and for the people who are tuning in, thank you as well. My name is James Oddo. I am a junior in the AIM program studying finance, and I cover the domestic financial services sector. Today, I will be pitching a company called Employers Holdings Incorporated, ticker EIG. Employers Holdings Incorporated is an insurance company headquartered in Reno, Nevada, operating out of 45 states and the District of Columbia through remote locations and online services. Employers Holdings offers workers' compensation commercial insurance. They get their earnings from the ratio of their premiums earned over the given period of time, investment income, and debt to equity securities purchased with the intent of selling them before maturity. This essentially means that they create products for workers' compensation, sell them to multiple small businesses around the United States and the District of Columbia. And then from there, they're hoping that they have a lower amount of claims so they don't have to pay out. So with their premiums, they then invested in their portfolios to get more income. Now on to my recommendation. Employers Holdings has provided America's small businesses with cost-efficient workers' compensation insurance for over a century. Financially, Employers Holdings holds a strong capitalization and operating performance levels. AM Best, which is basically a credit rating system, much like how they rate bonds, but this time it's for this is for workers' compensation companies. They rated EIG an A-, which in their rating scale is an excellent company. And they said, quote, they have a positive outlook for the future. In 2019, EIG plans to increase their operating expenses by 400 basis points on top of 2018's 200 basis point increase. This plan to increase the operation expenses by 400 basis points, This will support the rollout of the company's digital to direct consumer workers' compensation subsidiary, CDEV. Management has anticipated another 600 basis point investment spending increase on CDEV throughout 2020 due to the booming market for InsurTech and the impact it has on their claim process. Considering all the benefits and future growth for EIG, it is recommended that Employers Holdings be added to the AIM Equity Fund with a price target of $56, representing a 40% upside, offering a 2% dividend yield. Oh, that's my series. Sorry. Now on to my first driver. The first driver is the full realization of CDEV. It's no surprise that much like every industry in the world, that the insurance quotes are starting to change. CDEV is a subsidiary of Employers Holdings Incorporated, and it is a digital direct-to-consumer website dedicated to providing small to micro businesses with workers' compensation insurance policies and quotes. The online CDEV currently covers flood, medical, office, and retail within those small businesses. In the long-run benefits of CDEV is its impact on the future revenues and expenses due to its ability to generate higher revenue growth from the new market of online insurance, and the future decrease in expenses due to the less employees needed to run the business. This doesn't mean that employers will be firing its employees. It just means it may not be replacing them after they retire. After spending just 30 minutes on the website, I was able to generate multiple different quotes under multiple different scenarios. And I was able to look at external links providing information with how to handle specific workers' compensation claims. This platform is very user-friendly as expected to exit its testing stages in late 2019 or early 2020. Onto my second driver, California revenue and market share. This driver has two parts to it. The first is the future events in California with small businesses, and the second is the current events in California. I will be starting with the current events. California has seen some issues with wildfires this year. In 2018, 2018 was particularly a disastrous year for them. While it is difficult to predict the exact damage for future fires will cause, it is certain that California will have their expect in the fire season. Since Employers Holdings operates out of both fire and casualty segments, due to these events, California's has seen a steady increase in the cost to carry workers' compensation. And since California requires that all companies have workers' compensation, this means that they're going to have it in their portfolios, and that due to this cost increasing, Employers Holding will see an increase in the revenues there. Moving on to the second part, California's government data suggests that businesses with less than 20 employees make up 88% of all businesses and employ 18.2% of workers in California. As stated previously, it is California's law that they do provide all small businesses and regular businesses with workers' compensation. Due to this exposure of small businesses in California, it is expected that their market will continue to be a major player for the revenue growth in Employers Holdings. Now on to my third driver, book value compared to competitors. So Employers Holdings 2019 estimated book value is at 1.18. This is an industry this is their average from comparing this to their 10-year average low book values of the 52 weeks highs and lows. This is a record-breaking price to book value, meaning that using Excel, I calculated the highs and lows of the 52 weeks from 2006 and compared it to the end of the year book values, calculating each of the price to books. The 1.18 was pretty much at its historical low here. And in past times, EIG has seen a 30 to 35% growth in 2011 to 2012 and 2014 to 2015 in those times of low price to book ranges. In 2017 and 2016, price to book value for Employers Holdings was at 1.6 both times. Additionally, IEG is expecting a steady decrease of price to book value into its terminal year. I will be touching on one point of my valuation. I did conduct a 2018 actual price to book ratio just to solidify my 2019 values. However, I did not include this into my final valuation. It was just to show the solidity of the price to book. I will only be touching on one of my risks, the reliance on independent agents and brokers. Employers Holdings Company sells majority of their insurance product through their non-exclusive insurance agents and brokers. So this basically means that these agents and brokers can pretty much choose any insurance agents they want, or any workers' compensation insurance company that they want to sell to their customers and stuff like that. So along the lines, it comes down to the point of, will those agents and brokers be loyal to Employers Holdings or other companies? And for management, the last thing I would like to touch on is the CFO. The CFO is relatively new, joining in January 2017. Since the CFO has been there, they have seen a couple of changing in accounting estimates, which has caused some volatility. But now that the CFO is starting to mature in the company, I'm expecting to see a little bit more of a steady growth instead of the volatility. I would now like to open up the floor to questions.
So just looking at your drivers, first off, you mentioned in like 3 other places that your price to book value is low. I'm not really sure that's a driver. So going to your second driver, it's more kind of like a macro thing. There's 8 other workers' comp companies that are larger in California. So what kind of differentiates your company from that?
Sure. So in California, Employers Holdings is the only company that predominantly only focuses on workers' compensation. Most of the other insurance companies will have a portfolio of bigger type of products that they offer, meaning along the lines of like healthcare or something like that. So since we specialize in that, I'm expecting it to see all of their expenses going into improving their workers' compensation, and also tying it in with my first driver there. Once CRD is fully released in the United States, I'm also expecting and with casualty and fire, I'm expecting to see growth in California due to the direct to consumer ease of that website.
So your revenue increases in
Sure. So as mentioned in my recommendation, management is expecting a 600 basis point increase in expenses. So that's pretty much what's happening there with the net income.
So I just kind of want to jump to like your last page.
Sure.
I see in your peer charts you include market cap twice. I guess, and then one of your company's market caps is different than the ones that you show in the other section as well as in your first boxes. So I guess which one is the correct one?
Oh, I do see that. Yeah, the market cap on the bottom peer analysis chart is the correct one. I'm sorry for that.
Yeah, quick. So then I guess seeing that you included twice, why is it so important, or do you have something else important as well as the stock price? I think that doesn't really exactly show anything to us. So do you think there's something else that could have been?
Sure. It actually is an error that I included it twice in there. If I were to add another thing in there, it'd probably be ROIC or EPS.
And then real quick, last one. So I can see that your formatting is not exactly correct on these charts. So I guess my question is, were you at the workshop you provided?
I actually had an acapella performance that day.
Okay, who was it?
I'm just sort of confused about your second driver. You say they operate in fire team casualty insurance. How is that connected to their ability to provide workers' compensation?
So the workers' compensation insurance pretty much covers that whole umbrella of things along the lines of fire and casualty. It's basically injuries within the workers. So I'm saying the fire caused by the injuries of employees along those lines. But the main point of that driver is not the fact that we want to be giving those quotes to the people. It's the fact that the companies are now going to be preemptive to the issue of having fires and need to be getting more workers' compensation insurance included on top of the fact that the rates are going to rise because of the fires. Mm-hmm.
Yeah, touching back on Nathan's question about your revenues and net income.
Sure.
I understand how like that you think that they said they're gonna grow 600 basis points their expenses. Why does expense ratio not go up then? If expense ratio goes down, I'm just a little confused as to how you model.
So actually the 600 basis point increase in the expenses is actually considered into the loss ratio, which is the difference between combination ratio and expense ratio.
Okay, and then a quick one on the combined ratio. What really is that all is the 600 basis points what's driving that almost 10?
Correct.
Almost 10%.
Yes.
Real quick one about that.
You mentioned the CFO had a lot of accounting revisions. Were any of those related to actuary revisions?
I am not sure, but I didn't read, there were no actuary revisions with anything I read, but I'm not 100% sure.
Third driver, we do fundamental analysis, and I think this is more technical analysis to say that the stock price jumps after they've got a low PB is technical, not fundamental. And so my other question, I guess, about this is, did companies say that they expect PB to decrease into its terminal year, or is that just what you're estimating?
That's both estimation and sell-side research.
Okay, got it.
Quick one with Shane.
You say management expects 76% of small business owners within Cerity's target market. Can you kind of explain how large Cerity's target market is?
Sure. So right now, Cerity is only operating out of 4 states, predominantly Illinois. Like I said, it's still in its testing stages. So basically, what it's saying here is that 76% of people who own small businesses are currently trying to use a direct-to-consumer platform instead of the traditional face-to-face type of workers' compensation insurance. So once this is rolled out, it's expecting just that market of 76% of those small businesses to be within their target range.
Okay, James, thank you.
Thank you.
Pat, we're gonna have Edward go first. Edward?
Hi, before I begin, I'd like to make 2 minor adjustments. Midway through my recommendation, there's a 1-year CAGR for the CRB. That sentence should just not be there at all. And then my price target is actually 827. We're representing an 88% upside rather than 785 at a 79% upside. Hi, my name is Edward Eisenhauer, and I'm a junior in the AIM program covering international technology and telecommunications industry. I'm a finance and information systems major. I will start with my recommendation, cover 2 drivers, and finish off with a risk, and then leave the rest of the time for questions. I will be pitching Pareteum Corporation, ticker TEUM. Pareteum is a communication platform as a service software company focused on connecting everyone and everything to the cloud. Pareteum services allow customers to manage communication networks, its related data, CRM systems, and billing operations to rapidly deliver new and tailored offerings.
The global software cloud platform gives customers the ability to manage these business processes in real time from anywhere via the cloud. This platform replaces on-premise legacy solutions such as business service solutions and operational support systems, while also integrating the two. These architectures handcuff telco companies by not allowing cheap and quick innovation of products and services. Since the restructuring in 2016, TEUM has experienced a 3-year sales CAGR of 39%, with 2018 year-over-year sales growth of 139%. A key metric used to measure future revenues is the company's contractual revenue backlog, or CRB, and its backlog conversion rate. The CRB consists of signed contracts that Pareteum is working to fulfill. In December 2017, the CRB was $145 million, grew to $700 million by February in 19, increased to $800 million by March 19, and is currently at $900 million. This growth in CRB measures to a 1-month growth rate of 14% between February and March, and management estimates the CRB will exceed $1 billion by year-end 19. In addition, the company has a 3-year history of 100% or more backlog conversion rate. I will now break down the conversion rate. In year 1, 15% of revenues come from implementation and initial pricing. Year 2, 30% from monthly recurring revenues based on the number of connections. In year 3, 55% of monthly recurring revenues and increasing number of connections. Now that breakdown is for a single customer contract. On to my drivers. Expanding market capabilities with recent acquisitions. Pareteum acquired Artilium and iPass in October 18 and February 19 respectively. Artilium is a telecommunications software provider offering streamlined business processes similar to TEUM. iPass is a global network of Wi-Fi points offering interruption-free internet access between Wi-Fi and cellular networks. While TM is focused on the service provider end of the market, Artilium's business focused on the retail and enterprise end of the market, opening a new target market for TEUM. The iPass acquisition adds even greater value to TEUM by adding 75 engineers and an enormous hotspot network. These engineers do not have to be trained and can immediately start working on TM's backlog. This hotspot network adds 64 million Wi-Fi connection points in 180 plus countries, greatly increasing TM's platform connectability. This acquisition expands TEUM's total addressable market as it adds 500 companies to its customer base with immense cross-selling opportunities. These customers will soon benefit from the expansion beyond Wi-Fi access services and into a full suite of cloud platform connectivity and software communication systems. Together, the acquisitions give TM a complete solution under a single platform, extend TEUM's footprint globally, and further enable them to connect everyone, everywhere to the world's largest Wi-Fi network. Technological disruption. TEUM's growth prospects and valuation are driven by the new and emerging communication technology and service that can tend to all the customer's needs under a single platform, unlike any other supplier. TEUM's product is disrupting the telecommunication industry by utilizing the cloud to connect people and devices, thus eliminating infrastructure spending. A majority of the communication industry still uses on-premise solutions and has shown strong movement to these software as a service platforms. TEUM's unique proposition is depicted by the net dollar retention rate, which has grown from 147% to 214% from December 18 to March 19. This rate means not only are contracts being renewed, but are being expanded by 2 to 3 times. While TEUM's revenue growth from fiscal year 16 to 18 measured by 39% CAGR, the industry average is 6%, emphasizing TEUM's disruptive position. TEUM has been able to capture much of this conversion with the number of customers growing from 25 at the end of 17 to 533 by the end of 18. Now on to my last risk, backlog clarity. As explained by management, the CRB consists of monthly recurring fees, but also incorporates a usage fee based on the number of subscribers or connection points. It has been determined that the publicized CRB assumes a level of usage fees. This creates uncertainty around the actual total amount of the backlog because it relies on the success of the customer's business along with the success of TEUM's offering. To take this into account, I modeled an 80% backlog conversion rate into my DCF, resulting in the current target price. I also determined the stock price break-even point where TEUM would have to convert at least 60% of the backlog for the next 7 years. To conclude, as the internet did for information, Pareteum's mission is to create an easily accessible open mobility system for the world. Believing that open software and interfaces will create more innovation, economic freedom, and opportunity worldwide. Based on this mission and its strong growth prospects, it is recommended that Pareteum be added to the AIM Small Cap Equity Fund at a price target of $827, representing an 88% upside. And with that, I'll open the floor to questions.
Ed, sorry for bringing this up when you're pitching, but guys, we had the seniors come in and show us like how to format these reports, and these things are just like ugly. Why should we care about these questions that we're asking and try to talk about this company when you guys are negligent when it comes to like the formatting and stuff? Like, I hate to bring this up and I hate to be this guy, but like, just can you answer for everybody and just kind of say like, why should we be talking about this company when this formatting is like off and stuff?
What formatting?
Just like your guys' boxes and like not caring about like the way things look opposed to just like talking about the company.
Right.
Yeah.
We'll take this offline, but good point, you know.
I don't-
You have to address
I
it.
don't believe he's referring to. I don't believe he's referring to my boxes. But to speak as a program as a whole, it is very important to have very clean formatting because it does represent the AIM program as a whole and the quality of products we're trying to produce.
So, my question is in regards to like the milestone.
Yeah.
You know, it's down 20% this week, and if you were to purchase it, and we're about to go off this summer where we can't manage. If this were to fall, what would you set like a hard sell at? I know it's recommended 25, but that's, you know, adjustable. What are your thoughts on that? Have you thought about that?
Yeah, I've done a lot of thinking. I know why the stock has fallen of recent days. First of all, it's the last risk I just mentioned, that backlog clarity. Plus, one of its biggest institutional holders just sold it. And this is for a variety of reasons. This is a high reward, high risk stock. I truly believe that its platform and its mission will be successful in the future. For a hard sell, I would just do the typical what we do for our investment policy, which would probably be 20%. I don't see it going down much more. I actually think this raises an opportunity for us to even increase our upside. As you see in my box, my price target or my current price was at $4.39. So now I believe it's sitting at about $4, which even increases the upside even more. So I'm not really worried. I'm actually excited.
All right, we're gonna go with quick questions, quick answers.
So, my question is in regard to your third driver. It's at the backbone of their service and value statement is the ability to keep the customers connected. So what kind of differentiates them from like Salesforce, which also CRM, also has network connectivity, data analytics, it's cloud-based? What are they doing differently, and do they have patents to protect this?
Yeah, so they have other more than 40 confirmed patents that do protect their software. And this company, even though Salesforce does a similar type of business, Pareteum is on an entire another level of business operations. So they are the only company in the space that is able to manage these business solutions, operational systems all together, put it on the cloud, while also integrating cellular networks and Wi-Fi hotspots, where Salesforce does not have that expansion of capabilities. Salesforce is just a fraction.
So kind of backing up on that third driver, it's like a lot of information is based off of how they're growing and things like that. But sort of number where you can pinpoint what's going to exactly be affected by the driver.
Can you repeat that, please? I don't understand the question.
Can you just give me like some sort of number on that third driver as to this is exactly the result of this?
Yeah, so the network effect driver is not so based on numbers as it is kind of a theoretical moat. The network effect, by the ability to, for every customer they gain a number of connection points and subscribers. And by doing so, Pareteum is able to add more value to their connectivity services. So for each customer, let's say a customer has so many Wi-Fi points in an area, Pareteum is able to access those Wi-Fi points to not only serve that customer, but to serve all the customers. So the network effect is really just an exponential theory that as this company grows, not only will become more valuable, but will also be harder to compete with.
All right, real quick. You have a question?
Yeah.
So,
So,
quick answer.
do you think that the recent increase in backlog, which you use to project revenues, pricing of the stock, since it's gone up a lot for you?
Yeah, it is pricing the stock to an extent. But this is the driving force, and it's not just the backlog that is priced in, but it's or not modeled in, but it's also the growth of this backlog and the customer growth too. So it's much bigger than just this backlog, but the backlog I think provides good clarity for the future.
10-second question, 10-second answer right here.
Edward, last month in March, they had a pretty aggressive month, they started adding new customers. Why do you think they took off so much in the month of March, and how do you see them carrying on with that?
For the month in March, I can't speak to the month of March specific. Oh, yes, I can. So in March specifically, for 4 weeks in a row in March, every week they announced new customer contracts. And as you can see by the backlog growth numbers, it was an immense amount. So that really was their takeoff point.
All right, Edward, thank you. And Vieth is pitching fourth right now. Gladstone Land.
All right. Sorry. Good morning, everybody. My name is Matthew Vieth, and I'm a junior in the AIM program covering the financial services and domestic real estate sector. And the stock that I'm pitching today is Gladstone Land Corporation. Gladstone Land Corporation is an agricultural real estate investment trust which engages in the business of owning and leasing farmland. It also includes farmland-related facilities such as cooling facilities, patching houses, processing facilities, and various storage facilities. The company was founded by Davis Gladstone on June 14, 1997. On to my recommendation. Since its IPO in 2013, Gladstone Land Corporation has generated promising dividend growth and income for investors. Gladstone has a current dividend yield of 4.3%, which is more than double the average yield of the S&P 500 index. Land also pays its dividend monthly rather than quarterly. The firm is a unique REIT because it owns farmland, while most other REITs own buildings on their properties in multiple industries. Gladstone's portfolio includes 85 farms in the United States, including over 73,000 acres, with a reported value of $618 million. Gladstone Land leases these properties to farmers, which are typically triple net, meaning that land receives a consistent stream of income, and the tenants are responsible for real estate taxes, insurance, and maintenance expenses. Furthermore, many of these leases include crop sharing components, which allow land to receive a piece of the revenue farmers get when they sell their crops, variable to changes in agricultural prices and the crop type. Gladstone focuses its interest primarily in fresh produce, which management believes is the agricultural class with superior long-term earnings and performance potential. As a result, land generates strong cash flows which shareholders reap benefits in the form of increasing dividends. Gladstone has positive growth aspects because of its position to benefit from two major long-term trends. The first being the growth of the global population, which consistently increases the global demand for food. And the second being the increasing population, which reduces the supply of farmland as farms are converted into suburban developments, causing land prices to increase as supply decreases. Further, future growth will also be increased through continued farmland purchases. With the market being diverse with many small family farming operations, there continues to be ample amounts of quality farmland that can add to its portfolio. For these reasons, it is recommended that Gladstone Land be added to the AIM equity portfolio with a price target of $14.73, representing an upside of 18.86%. Now on to my drivers. First, trade dispute with a long-term view. While the current trade war between the United States and China creates much uncertainty and has weakened the agricultural prices, short-term bearish headlines associated with the trade dispute are hiding opportunities for long-term gains. Eventually, a trade settlement between the U.S. and China will be reached, which will positively impact prices and exports of crops to China. When exactly this will happen is unsure, but taking a long-term perspective, coupled with the demand and supply shifters mentioned below, represents great opportunities for future gains while prices are low. Midwest flooding. Recently, the upper Mississippi and Missouri River basins, which include Nebraska, Minnesota, and Iowa, have experienced record flooding this year. Roughly 2/3 of the lower 48 states face an elevated risk for flooding through May. This flooding poses a threat to the number of acres that will be planted in 2019, but its full impact will not be known as it's still early in the planting season. While this is a threat, this also creates an opportunity because if less supplies are generated, then prices will likely rise. Gladstone Land seeks out high-quality farmland at attractable prices, which means they can weather the storm better than most small farmers can. And lastly, ethanol demand. Ethanol is a fuel source produced from corn, which is mixed with gasoline. China is adopting an E10 policy in 2020 without sufficient domestic corn production capacity to match the new ethanol demand. The U.S. currently has an E10 policy and is pushing to increase this to an E15 policy, a 5% increase in ethanol demand. These events will positively affect the commodity price of corn, which benefits tenants and lands flexible contracts with crop sharing stipulations.
Yeah, I think we'll need to move right into Q&A.
Aye.
I hope somebody asked some valuation questions.
Mhm.
Given the time, we have 2 presentations yet. Before we go. Go back here.
Tells us going on in 2018 with high revenue growth, negative operating income, positive EPS.
They made a lot of land purchases that wore into their operating income from changes in net working capital and just asset increases.
Yeah, I'm just gonna jump straight to your risk. I've noticed that you copied and pasted them straight from the 10K, so I guess it's what value did you add to this section so you're accurate on that?
Well, I mean, those are the main risks that you can make with any agricultural business, whether or not it's copy and pasted, it's the same thing either way. But what you can take away from this is that trade debates aren't something that necessarily are long-term trouble with agricultural businesses.
So the street has EPS negative in 2019 and 2020, and you have them positive. So I guess what are you seeing that other analysts aren't?
What I see with it is that the continued purchasing of new assets will help them create new earnings per share, but then also seeing that this trade dispute does end and helps the commodity prices, which would greatly increase their potential earnings.
All right, I have a lot of questions. I'm gonna start by saying that the boxes on the last page are an absolute mess. If you wanna get together after, and I can show you how to format those better, but there's really no excuse for them looking like that. That's kind of what Gino pointed out.
All right, let's go to questions.
So my question is, and I asked this last time, what's your terminal growth rate?
2.75%.
Any other questions? Andy, yeah, get back.
So your first driver and second risk are both focused on the trade debate.
Mhm.
Is the impact on your company with this, is it that they export crops to China, or is it just the fact that will impact commodity prices?
So they are actually in a much better position compared to other agricultural business because, like I said, they are focused on produce, not as much commodities like row crops. So those are less volatile when it comes to pricing with commodities. But then also, none of their products are going to exports to China and stuff. They're all in domestic U.S. So really, the only shock that they have is that price change that everybody's affected by. So they're not at risk of losing, contracts because of the high tariffs. But they stand to gain a lot if prices rise, globally with a trade. And
Patrick has a valuation question.
Just regarding how you weighted your valuation methods, I see that the DCF is kind of an outlier as far as what kind of upside it brings. How did you decide to weight those equally?
I wanted to treat them equally because I thought they all had good bearing, but I wanted to give, the DCF a higher weight because I think that's the potential with farmland is the future and future cash flows.
Time is short. Quick question here and there, and then we'll move on.
My question is regarding the crop sharing leases. It seems to be a major thing that you bring up multiple times. Can you just talk about what percentage of your revenue comes from that and kind of the outlook moving forward?
So I don't have exactly those numbers on where they're, how much they're gaining from crop sharing leases because those contracts are a little bit hard to dig up, but I can get back to you with that.
Yeah, so I mean, I've never valued a REIT, for like funds from operations, something that people use. I guess first, did you really look into it? And then in terms of dividends, looks like they're getting pretty low compared to the 5-year average. Some people feel comfortable with just finding out what the dividend is like on it.
Well, that's why I think this is a valuable opportunity because it is trading low relative to its dividends. So I think going forward with that growth and just the changing industry, that's where that potential is for profit.
All right, Matt, thank you. We gotta move on here. All right, last presenter, another Matt. This is a domestic financial event. So we're gonna do this to you. You're gonna have to do your pitch in like 4 minutes and then we'll have 5 minutes.
Yeah, no problem. I can hustle through it. Okay. Hello, I'm Matthew Prinske, and I'm a junior in the AIM program covering domestic financials. Today, I'll be pitching Veritex Holdings, ticker VBTX. Veritex is a community bank based out of Dallas, Texas, with a large footprint in the Houston area as well. The bank has been expanding significantly, both organically and inorganically, since their incorporation in 2009 and their IPO in 2014. Veritex Bank has seen tremendous growth since the end of the Great Recession. I estimate an organic 4-year net income CAGR using industry average PE of 15 times earnings to assume earnings, and I know that total acquisition costs were about $280 million. This gives an organic net income CAGR of about 40%. The loan portfolio of Veritex Bank is significantly skewed towards commercial, accounting for about 75% of total loans. This can be a catalyst to further growth as companies are likely to grow and require loans in the area. Next, I will touch on my drivers. The growth in the Texas economy is stronger than most areas within the United States. The economy in Dallas is spurred by strong technology, financial service, and defense sectors. The growth of the local economy will find its way onto Veritex's financials through loan and deposit growth, along with housing price lift. As companies expand to fill the level of demand brought in by large population growth, Veritex will stand to profit by loaning to commercial loans. Secondly, the increase in individuals will force real estate prices up and spur in housing sales. Next, residential real estate accounts for about 14% of Veritex's loan portfolio. About 30% of Veritex's branches are located in the Houston area, so this is the assumption used on the residential real estate exposure as well. Post-Hurricane Harvey, real estate slowed significantly. However, nearly 2 years later, the market is back in full swing. Hurricane Harvey will have a lasting effect on the asset quality, though, as a significant amount of money was used to update houses hurt by the hurricane. This leads to better quality home without additional capital being given out by Veritex. Lastly, the acquisition of Green Bank will expand Veritex's ratios. Green Bank has had better ratios than in most of the significant areas, and this will be seen over the coming year. Synergies from this acquisition should be seen in Q3 and Q4 of this year. However, ratio lift should be seen much earlier than that. I expect the ratio lift to be reported on the first earnings report of 2019. With all of that being said, it is recommended that Veritex Holdings be added to the Marquette AIM Small Cap Equity Fund with a price target of $30.21, representing a 21% potential upside. For the sake of time, I'd like to open the floor for questions.
Moving it up here. Who's first? Texas Bank. Regulatory, what's the regulatory environment like in the state of Texas?
It's not much different than the U.S. economy overall. They're still under their $10 billion in asset threshold after the acquisition. So to keep them under those extra regulatory requirements.
Tier 1 capital ratio?
About 12.18%.
You look back in the past, what's that been? Is that?
That's right around where it's been. There hasn't been much change.
The tier 1 capital ratio, have you looked at like the competitors and how they're able to, or like how they hold their reserves?
Sure. Competitors are a little bit higher on their tier 1 capital. They hold a little bit more in non-interest bearing assets. Deposits.
How does it go with that in terms of if they go down, would they be able to pay out or loan out stuff?
Yeah, they have a loan to deposit ratio around 97%, which I feel very comfortable with given the interest rate environment right now.
Do you have your calculation for the prospect rate?
Sure. It was a beta of 0.4, risk-free of 2.49. That was the 10-year equity risk of 6.25.
Yeah, you want to talk about what happened in October? Stock price seems like based on the chart.
They missed earnings significantly back in October. That was due to a one-time charge-off from acquisition charges, legal charges to the
Can you talk
acquisition.
about your third driver and why you think it's not already priced in?
Sure. So as I said, as I actually just mentioned, the stock was hit significantly back in October with that earnings miss. And in terms of the merger, the ratio lift, which I was talking about, the synergy is supposed to be seen in Q3, Q4. But because Green Bank had significantly better ratios, especially efficiency ratios, that's going to be coming in immediately. I'm expecting an immediate impact in Q1.
Did you do an analysis of what your upside would be if you didn't include first financial tax years in your
They were only valued at 5% into the valuation. I didn't check without them, but they're barely.
Well, we have time for one or two more here. Dividend?
Just paid their first dividend, 12.5 cents quarterly, put out to the year 50 cents for
Any
about a
indication
2%.
on dividend policy? Is this a one time or is this gonna be?
I believe it's supposed to be recurring, quarterly recurring. In terms of my modeling, I assumed the same dividend payout ratio just because I don't have a history of it. This is their first one.
Ben?
You talked about the $10 billion threshold. Are you looking like exceed that?
Yeah, definitely. If the opportunity presents itself, management guided that because this is one of the biggest acquisitions they've made, they're going to take this year and really try to make sure that this acquisition is implemented well, and then look for possible growth opportunities. I don't see them growing inorganically again until maybe Q2, Q3, 2020.
That acquisition, what does that do to the loan portfolio? Does that change fundamentally the business risk?
The breakdown in portfolio was similar, but Green Bank had a little bit higher asset quality within their portfolio.
Primarily, where's that located? Does that expand your footprint?
No,
Overlap?
it keeps them right in those same two markets, and I believe they're selling off one of the branches that they didn't in the Austin market that
Look at
didn't
their
exactly work.
digital presence. We know that community banks are challenged in this interest rate environment of 2.4% cash return on like robo-advisors. These community banks can be greatly influenced by the outflow of deposits. Do they have any counter to that?
They have a little bit of an online presence, but like you said, it's a little bit harder as a community bank, which they are working.
Thank you, last question.
What's like their non-interest deposits?
That's a little bit under competitors' non-interest bearing deposits. It's about 25%, and the competitors are a little closer to 30. It was rising post acquisition.
Okay, thank you very much. We do need short buy sell right up by tomorrow. We'll have a chance to talk about that this afternoon. We're going to Northwestern Mutual. I know. Presentation 30 stuff. Probably start at.
I don't, because that's like, I haven't talked to you guys for like 2 years. So it's like,